Thanks for joining us today. I'm Dan Cook with Nadex. Today we're going to be talking about Nadex knockout options. Now, if you've been with Nadex a little while, you might know these also as touch brackets. Recently did a name change, and actually that was based on a lot of feedback we were getting. Kind of funny when people were calling in, they were saying, yeah, your knockout contracts, these knockouts, those knockouts. That and for a few other reasons, it just made sense to update the names. So if you're familiar with touch brackets, this should maybe be a confirmation of what you know or a few other items you may learn. But with that, let's get started. Just a couple of housekeeping tips. If you do have a question, just type it into the question box. I will be taking questions at the end. A lot of it will be answered through the presentation. If I do see a question that comes up and is pertinent to that screen or the next, I'll take them as we come, but we'll definitely leave enough time at the end to answer any questions you have regarding these contracts. So with that, before we get going, quick risk disclosure. Hopefully you understand that trading on Nadex does involve risk. Trading isn't appropriate for everyone, right? And it may be appropriate at certain times and it may be appropriate at other times. So it's up to you to really understand the risk involved. Make sure it's right for you. Always make sure whatever you're doing, you're using risk capital, not capital that's reserved for groceries or mortgage or car payments. That is the surest way to lose money in a market, right? So understand the risk. I think one of the greatest things about Nadex and contracts we offer are the defined risk. You've probably seen a lot of disclosures before where you can lose more money than you have in your account. That is true in a leveraged market, but the way Nadex is designed, we wanted everyone to be able to access the markets, but do it in a reasonable way, in an appropriate way. And so that includes defined risk. So you can lose all the money you put up for an individual trade. You just can't lose more than that. So I am going to be looking at the charts in a little bit. If you've got a live account, don't follow along with any trades I place. Those are purely for example only. So please do not think that that's a trade indication or a recommendation to buy or sell anything. All right, so today we're going to be going over the markets available, what these contracts are, how they work, what does it look like from a risk-reward perspective? You know, what are the capital requirements? How much money do I have to have in my account, or how much do I have to put up to place a trade? And then we're going to walk through a trade example, and as I mentioned at the end, we'll have plenty of time for questions. So the markets available, we're always looking to expand these, by the way. So your feedback is important into this. So these are the markets that are currently available. So we have 4 major currencies, the euro, pound, Swissian, Japan, all with the dollar as the other currency. 4 major US indices. So the US 500, the small cap 2000, the tech 100, the Wall Street 30. Recently, just a couple months ago, actually, we launched commodities. So we now offer crude oil and gold as well. Now, crude, as you can guess, if you were looking at the markets at all in April, was huge for these knockout contracts. Obviously, crude going to below zero was something that was kind of shocking, I think, to most of the trading world. But with volatility, and we'll talk more about that, but with volatility, these contracts offer a lot of unique features. So if you have been trading futures or you always wanted to trade crude, but you didn't want to risk $1,000 a point to do so, here's a way that you can have exposure to the crude market and speculate on that. Gold as well. All of these contracts are designed for the individual trader, not the institutions. So let's get into what they are. So they are effectively a contract that has a price range. Very simply, there are 2 price levels. The lowest price is called the floor, and the highest price level is called the ceiling. Hopefully that makes sense, right? Those are your boundaries. So you have a floor and you have a ceiling. So between those 2 values, the floor and the ceiling, the price of the contract will move in line with the underlying market. So if you've been trading things like FX, if you've been trading things like stock index futures, this will look very familiar from a movement perspective. It moves very much just in line as the underlying market moves. So why these are called knockouts? If the index for that market touches the floor or ceiling, that contract is expired at that value. And again, we'll walk through examples of this. I'm not a big one. I'm a technician by trade when I'm trading. So words aren't necessarily my friend when I'm trying to get a concept. So we're going to walk through some visuals on these in just a little bit. So each knockout has a maximum duration of 1 week. At the beginning of the week, we list 4 knockouts per market. The structure of these is very much designed so whether you think the market's going up or going down, you can have a trade where you have lower risk with a high potential return on that trade. So if the floor or ceiling, again, is touched, that contract is expired, a new bracket will be listed to replace that, right? We always want to try to do our best to keep 4 unique knockouts to choose from. Now, you'll only be trading 1 at a time. In some cases, you may be trading 2 at a time, but they are all independent contracts. So you can just choose bracket number 1 or bracket number 4 or 2 or 3. So in almost all conditions, there will be 4 unique knockouts to choose from. There are a few exceptions. We'll touch on that in a bit. So let's walk through a visual example. So on the right-hand side of my screen, you'll see that blue arrow pointing down. That's the current market. So the opening level is 27.20. So at the beginning of the week, we're going to launch 4 brackets. So they'll each be offset to the market. So the first one comes out with an offset of 10 points, the market 10 points from the floor, ceiling 40 points. And you'll see this in a stair-step fashion. So each market is designed. So this is the US 500, which is based on the CME, E-mini, S&P. So each market will be a bit unique in the structure, right? Because they're based on how the markets move. So if you're trading Euro USD, each contract will have its own range and own value. The US 500 will have a different one. The Dow will be based on a different tick size just by the nature of how that market moves. So a very unique stair-step structure. Here's the middle of the market, so you can see all 4 brackets are really in play. In the case of bracket number 1, the market is very close to the floor of that contract. If you go to the right, in bracket number 4, the ceiling is very close to the actual where the market is currently. And of course, they have a maximum duration of 1 week. So that red line that just popped up represents where this would expire. Now, they do expire 2 different ways, right? So let's get into how they work. So again, trades within this set range, capped by the floor and ceiling, and they expire in 2 ways. They can expire by getting knocked out by touch or by time. So let's take a look first at really how they get knocked out by touch. So again, either the floor or ceiling are touched, or if price even gaps beyond that. And this is where they're defined risk, right? You're never going to get slippage on these contracts, right? Wherever that maximum level is, that's where that trade ends. So even if it's a really volatile market like we saw in March, right? You don't have to worry about losing more than you expected. There's no nasty surprises. There's no margin calls at Nadex. You get all the effectiveness of leverage without that downside risk of, hey, sorry, I have to call my significant other and tell them the kids aren't going to college because I thought oil was going up and all of a sudden it just dropped $5, right? If I was doing this 6 months ago, a lot of people might have thought that was a far-fetched scenario. Fortunately, the markets really gave us a couple of rides this year, and there was a lot of people that lost a lot more money in the futures market than what they expected to do, right? Because of the volatility. That can't happen with these contracts, right? So once a contract is expired, a new contract is created and to replace it at a new level. So to define what a touch is, what a knockout is, if the underlying index is equal to or higher, so in the case of a small or even a large gap, it's going to knock out at that value. In the case of the floor, if it gets touched or if all of a sudden the market drops in a gap, it's still going to expire at that floor. So in certain cases, we always try to keep 4 brackets created. But if we get more than 1 bracket expired by touch simultaneously, meaning there's a big market gap, we'll bring the number up to keep 4 brackets, to kind of keep that opportunity rolling. And you'll see when we do the trade example what I mean by the contract rolling and how you can keep locking in opportunities. So it's really the same as any market. You buy if you think it's going up, you sell if you think it's going down, right? So let's go back to our previous example here. And here the market's moving. I'm going to go back just a second in case you missed that. If you pay attention to the left-hand side of the screen, so there's the underlying market, right? It just shot up. So it basically hit the top of bracket number 4. So at that point, if you were short this bracket, say you got in right at the start and you were short from that blue horizontal line, right? That bracket is going to be knocked out for your loss. That's the maximum loss. So that bracket is knocked out. Once that bracket is expired, a new bracket is going to be created. And so as you can see, it'll start to go up. If the market continues up and then knocks out bracket number 3, we'll see a stair-step pattern up. As the market is moving down, there'll be a stair-step down, right? It all depends on how they launch. All right, so if the market moves down, right? In this case, bracket number 1, the floor was hit first. So that bracket is knocked out. And as I was just mentioning, goes down in a stair-step fashion, right? Now, take this question as it comes in. So the question is about fees, right? So there's exchange fees of $1 to execute a trade, and then $1 to get out. So if your bracket is knocked out for a loss, so for instance, if you were long bracket number 1 and you got knocked out for a loss, meaning you got no money returned on that trade, in that case, there's no expiration fee, right? So if you get knocked out for a loss, if you reach your maximum loss, there's no expiration fee. So I do want to make that clear because it's pretty important when you're looking at these contracts to trade, right? So it's just the execution fee in that case. All right. So the second way they can expire is by time. So right at the end of the week, if we look back at March, it was actually pretty unbelievable. The knockouts actually made a great case, right? A lot of people would look at the contracts, or look at the markets, I should say, and be like, wow, the Dow dropped 900 points today. What the brackets really illustrated in that case, though, was that while it dropped 900, what was absolutely amazing when I looked at these visuals, I think one week we ended up listing like 720 contracts because they kept getting knocked out on the US 500, on most of the indices, right? Because they kept getting knocked out. But what was absolutely amazing was the intraday volatility. For example, I was asked recently, how this compared to 2008, 2009 timeframe, and how these would have performed and why certain things happened. And the big difference, and I went back and I looked at a lot of my charts from then, was in 2008, we had a lot of big moves, but they were big directional moves. We didn't see the intraday swings that we saw this time. And somebody who's been looking at the markets, really, I loved the markets since back when I was in high school, but really seriously looking at them since the late 90s, I have never seen anything even close to the volatility that we saw in March. The intraday swings, if you looked at the end of the day, yeah, it dropped 900 points, but what you didn't get from that daily candle was it dropped 600 points, and then it went to up 100 points, and then it dropped to 700 points down, and then it went to down 100, and then it went to down 1,000, and then it shot back to, down only 100 again, and then it closed at 900. It was those big intraday swings that were just amazing. And if you're trying to trade an outright market, an outright futures market in that, you're getting whipsawed to death. Now, you can get whipsawed in the knockouts, but you're not getting slippage. You're not getting those big gaps in price. So you always know going up. And there's also some strategies. So, Charles, I'll take that question in just a little bit on the profit side, right? One thing you'll notice about me, and one thing is a trader myself and a trading coach for many years, the first thing I'll ever talk about is risk. I want everybody to understand their risk, right? There's an old saying in the market, Amos Hofstadter, famous trader, take care of your losses and the profits take care of themselves. Now, that said, I want you to understand how to profit, right? At the end of the day, you're not trading just to take losses, but you need to be aware of that. So we'll talk about profit, particularly when we look at the trade example. All right, so I kind of diverged there. I try to throw in some things that hopefully you find interesting, but sometimes I ramble on a bit. So, all right, how they work. So at the end of the week, right, there's still going to be 4 contracts listed at the end of the week. So all 4 of those, because they're not knocked out, will go to expiration. So the expiration value is calculated on the market, just like all binary options, all call spreads, all knockouts, all of them expiring at the same time will have the same expiration value, right? So these are actually considered variable payout contracts. So don't think of these in the nature, if you've been trading binary options, which are all or nothing contracts, don't think of them in that light, right? These are variable payout, right? So they're settled using a calculation, the expiration value calculation. So the profit and loss when they settle, just like any market, right? If you close a trade, your profit and loss are determined by the difference where you bought or sold and the final settlement value of the contract. So let's just take a look at an example. Here's the end of the week, right? We had the market open over here. We probably had some brackets knocked out. Market's been moving down. We've got these 4 brackets, right? So at this case, those 4 remaining will all settle at the very same price. So if you were short bracket number 1, up at the top here, say that was around 28.10, and it settles at, say that's 27.80, right? You've made that 30 points, or in this case, $300 profit, right? If you were, let's say, long, bracket number 4, right from the center, you're probably about break even at this point. It might be slightly higher, in which case you'd have a slight profit, or it might be slightly lower. And so they're variable payout. In bracket number 2, if you were short from up here, right, it's still going to settle down here. And so at the end of the week, your profit loss for an existing bracket when it's expired by time will be determined by where you entered the market and where it settles. All right, so let's take a look at risk and reward, because this is absolutely how you look at your risk as well as your profit potential. So you know your maximum of each before the trade is placed, right? These are fixed risk, as all of our contracts are for both buyer and seller, so both sides of the trade. They have to know their maximum risk. And so by default, each one also knows their maximum profit potential. So both boundaries provide that access. It's really pinpoint control because there's no slippage, and they create natural profit targets. We often say they actually provide a built-in plan for every trade. So while I talk a lot about risk, and one of the things that I would see a lot, particularly as a trading coach, is somebody would get into a trade, and they might even have a trade or a plan going in, right? And plans can turn bad pretty quick if you're not really disciplined, right? So it's kind of built-in discipline, if you will. So what I mean by that is when I was working with a lot of newer traders, I'd see them put a stop in the market, and then we'd start to see the market, kind of move against them, and then the stop would start to move, or they'd have a mental stop. With this, once you're into a trade, that is fixed. You can't change that. So there's discipline by design right there. On the profit side, so if you're long, the ceiling, if it gets knocked out at the ceiling, that's your maximum profit potential. If you're short, right, the floor is your maximum profit potential. I'll hop into the platform as well to illustrate how this works. So there's that built-in plan, because another thing I saw was, we've heard fear and greed in the market, right? The fear, if you're trading like a traditional FX or futures contract, is that you get stopped out. It shouldn't be something you fear. Actually, you should embrace it, because that's showing risk control if you get stopped out. But on the other side, I'd have so many conversations where traders would have a trade go in their favor, but they would never lock in profit. Or they'd be like, oh, the market's going to run. And sure enough, as soon as they think it's going to run, then it just drops back down. Maybe they're only slightly in profit, or maybe now they're at a loss, right? Because they didn't lock in profit. So this structure, if it hits either of those maximum boundaries, think of it, if you're long, like the floor as a stop, a guaranteed contractual stop, and the ceiling as your limit order, right? If you're short, That ceiling is your guaranteed stop, and that floor is your built-in limit order, right? And so that's how it protects profits. Now, while these can expire, and while they knock out, they can, right, expire by a knockout or expire by time. One of the biggest mistakes I've seen in my years at Nadex on every contract we offer, every contract, right? Because every contract we offer has a floor and ceiling of some type on a binary option at 0 or 100. The absolute biggest mistake I've seen people make is that they don't close a trade early, right? So just because you have that maximum profit potential doesn't mean you have to wait for it to hit that, right? You can close out your trade. If you got long and the market starts running up in your favor, but all of a sudden maybe it starts going sideways or starts to drop a little bit, you can close that trade out. You can set limit orders beforehand to take profit. Similarly, if it's dropping, if you were long and it's dropping towards the floor, and maybe you were risking $50 initially, but all of a sudden it's dropping against you, close that trade. You can take a smaller loss. You don't have to take the maximum loss. People would really actually save so much money and enhance their return if they followed that principle. Now, that doesn't mean as soon as it goes a tick against you, you have to close it out or a tick in your favor, right? You want to let the trade work, but you should also go by your plan. And one of the things a mentor of mine from about 20 years ago, he had been trading about 30 years at that time, had told me, which was great advice, and something I learned a lot from, was that the biggest difference between him and a newer trader, a trader particularly that wasn't profitable, was that he got out of his losing trades faster. If the market determined he was wrong, it didn't matter where his stop was. If it didn't work the way he expected it to, he would close it out. Now, of course, in some cases, right, you close out a trade and all of a sudden then it runs in your favor and you're like, oh, why did I do that? And you'll always remember those. But if you really look at the numbers, if you track your trades, you'll find out that you actually saved a lot of money over the course of time, right? And I'll walk through the concepts of how you set a limit order and stuff when we get into the platform. So that's the built-in plan for every trade. That's how the maximum prevents your maximum loss, as well as will lock in profit if it hits that maximum boundary, right? So again, on the risk side, you've got the buyer. The buy price to the floor is your maximum risk. That floor is your guaranteed contractual stop. It cannot go lower than that. If you're selling the contract, the difference between the sell price and the ceiling, that's your risk. And it'll display that when we go into we'll look at the order ticket, right? Reward side, it's just the opposite. If you're buying, the ceiling is your maximum return. If it hits the ceiling, it's going to be knocked out. That's your maximum profit. If you're selling, right, if it hits that floor, that's your maximum profit potential, and it will lock in if that floor gets hit. All right, so let's take a look at this. We're just going to pick out a bracket here. We're going to pick out bracket number 1 with a floor closest to the underlying market. So, right, we have our start, we have our expiration, we have our floor, and we have our ceiling. Now, this particular contract is $500 wide, 50 points. The tick size is 0.1, so 500 ticks, all at $1 each. So if I buy this contract, and I'm going to buy it at 27.20, this is my risk. My maximum potential return is in the green, right? And this will fluctuate as the markets move. So you can always look though at your order ticket and see what these prices are, what the value is, right? So this is just a visual representation of risk, reward. In this case, I'd put up $100 with the potential to make 400. If I'm short, right, in this case, I'm going to sell at 27.20. Maybe this is bracket number 4. Now I've got the lower risk. I've got 10 points risk, or $100 in this case, with a maximum profit potential of $400, right? Very clean, very simple as far as how they work. It's simply a range, and that's the farthest points that this contract can move. From a capital requirements, if you're familiar with Nadex, you know that it's always your maximum risk. That's something you know before the trade is placed, and that's also your capital requirement. It never changes once you're into a trade. And this is an important point. If you've traded futures particularly, there's this thing that a lot of brokerage firms will offer that are called day trading margin, right? So if you're trading futures based on CME, they have what they call their initial margin and maintenance margin. So brokerage firms, though, can actually offset some of that risk from a margin perspective. So they'll actually give what's called day trading margin. Now, the thing is, as long as you close out before the market closes, that's fine. You get the day trading margin. But if you want that contract to go over their close or go beyond the day trading margin, you're going to have to put up what's called the maintenance margin, which is often 4 times the day trade margin. So it changes. That's something to be aware of in futures. That doesn't happen with these contracts. So even if you hold it, Nadex closes every day from 5 to 6 p.m. Eastern, our maintenance window. Even if you're holding a contract past that point, because your risk, your overall risk never changes, that capital requirement never changes. So if you put up 40 bucks to get into a trade and you roll through the night and the market's gone deeply in your favor, you still only have $40 risk. Even if it's gone against you, you still have a maximum risk of $40. Your floating profit loss has changed, right? But your risk hasn't. And it's the same for buying or selling. It never changes. So we really designed these to minimize the capital requirements to trade in both directions. You get a benefit of leverage, right? If you look at these compared to the actual underlying markets, you actually get a huge benefit of leverage, but without the unknown risk, right? There's no slippage, there's no margin calls. So you can trade on a per point basis, a larger size, with actually less money, but without that double-sided sword that is called leverage, right? So this example should look familiar from just a couple minutes ago, right? We've got the $100 from floor. We've got this, which is our risk. This is $100. We bought at 27.20. And again, this is just a laid out example. We'll show these on the order ticket when we get in a bit, how capital requirements and risk and potential reward as well as closing out early works. I do want to walk you through that because it's a very important aspect. Again, probably the most important. All right. So let's take a look at a trade example, and then after this, we'll hop into the platform. So here's a trade example, right? This will look familiar. You see that blue arrow and that line across? That's where the market currently is. We have bracket number 1, bracket number 2, bracket number 3, and bracket number 4. So, right, if you're already doing analysis, if you've been trading for a while, one thing to keep in mind is your analysis doesn't change, right? So if you have some type of strategy that you're using to forecast direction, right, and to forecast risk parameters, that doesn't change. This is the same market. It's just a different way to express a view in that market, right? So let's say we think the market's going to go up, right? We've got our weekly expiration there. We think the market's going to go up. We may choose bracket number 1. Now, the reason we would choose this bracket is because it's the best risk to reward ratio, right? We've got still a bit of distance to the floor, so we're taking on some risk, but we've got the greatest upside of any of these, right? Because if it hits the ceiling, if we're long, the ceiling is going to be our maximum profit potential, right? Now, in some cases, if the market had moved down and it's very close to the floor of bracket number 1, you may want to say, hey, I'll take bracket number 2 because I'm giving the market a little bit of room to breathe. Again, these are things we can take a look when we go into the platform. In this case, we're going to choose bracket number 1, right? Floor at 24,275. This is based on the Dow or Wall Street 30, right? We've got the ceiling 500 points away, or $500 in this case also. We've got our absolute expiration by time. So in this case, we're going to buy the contract at 24,375, 100 points or $100 over the floor, right? So that's our risk, 100 bucks. That's also our capital requirement. Our maximum profit potential is 400 points higher, right? So let's take a look at this trade, right? We get in, the market moves. Okay, so at this point, the market started moving against us. Now, we can wait to see if it hits. Now it's pretty close to the floor, so we might just wait to see if it hits the floor. As the market did this, though, right, if we bought over here and the market started moving sideways, we could decide to close this contract out, right? We could just say, hey, it's a wash. And there you go. So you know what? Hey, we're just going to take, instead of waiting for it to lose $100, maybe we're going to say, we're going to lose 50. And I'll show you how you close out these trades when we get into the platform. And you can buy these contracts at any time during the week. Like, there's going to be multiple contracts. You can buy them, Friday, 15 minutes before expiration if you want. Now, Friday afternoons are fairly slow. These are linear contracts, so you might not get a lot of movement in the market, although you may, right? So you can buy them at any time, buy or sell anytime during the week prior to expiration. So let's just say we decided not to close this contract out. In this case, wow, we got kind of lucky, right? Because it was very close to the floor, but hey, the market rebounded. Maybe that was our level of support, right? So maybe it wasn't luck at all. Maybe we're great technicians. And we said, this is the level of support. I'm going to let it run. And sure enough. Now, in this scenario, we could have taken profit anywhere across the center there. See where it starts to move sideways? This is one thing why I think a lot of times multiple contracts can be beneficial, right? Is because if you have, let's say, one contract on and the market starts doing this, you might say, hey, I need to lock in that profit, right? But if you have two contracts on, you can say, I'm going to lock in profit on one. And then if it goes back down here to my entry, I'm going to close it out, or I'm going to let it run. So in this case, we just let it run. The market went up, it hit the ceiling. So at that point, our profit is automatically locked in, right? We had a $400 maximum profit potential. That's locked in. Now, what happens when this contract gets knocked out? Another contract is created, right? So now we have another contract where we've got a floor that's offset but close to the underlying market and another ceiling. So we've already locked in profit, so we can't lose that profit, right? And so now let's say we decide to buy again. We think the market's going to go up. If it goes down here and knocks us out at the floor, right? Well, we still have all of this profit from where we originally bought, right? So it was still a good overall trade. This is kind of the same trade. We just rolled into a new contract. So this happens, right? Okay, so we made some profit. It went up. The reason I know we made profit is because the market is going to settle higher than where we bought. If it was down here, I'd know we were going to take a loss because it's lower than where we bought. So in this case, the expiration is 24,990, right? So our profit in this case is the expiration of 24,990 minus where we bought, which is 210 points or $210, right? So at expiration, so this trade, if we walk all the way through from start to finish, right? We bought back here at 27.20. If we bought one contract, it cost us $1 to get in. If it had gone down and knocked us out, it wouldn't cost us anything additional, right? We didn't make any money on the trade. When it went up and it hit the ceiling, right? It knocked us out for a $400 profit on the contract. At that point, on that contract, we would have a $1 per contract settlement fee. So if it was one contract, we'd have we'd have a gross of $400 minus the $2 that we paid for the entry and then the expiration fee. On the next contract we bought, right? So when we bought that, we executed it. It was $1 exchange fee for that contract. When it comes up here and it expires, right? Because it didn't knock us out for a loss, if it had come down and knocked us out for a loss, it would only be $1, right? So you don't get any money returned. If you don't get any money returned on the contract, then there's no exchange fee, is the simple way to do it. And here, if it expires here though, we made the $210. I don't know about you, but for $210 on this contract minus the $2 in the trade and expiration fee, right? It's still a good trade. So a profit of $208. All right, so with that, I've got some questions. So I'll come back to this slide, but let's hop into the platform and walk through these concepts because I want you to see how to actually, I think the questions are best answered actually looking at the thing. I'm going to go, in this case, into the indices. I'm going to look at the US 500. By the way, I'm going to make a note about the demo account, right? I think it's a very important tool to learn the mechanics of any market. And this is a demo account, it's not just at Nadex, but pretty much everywhere. And something you should be aware of, a demo account will never teach you how to trade, right? In the case of Nadex, now with the touch brackets or the knockouts, you're going to see they're pretty similar from demo to live because they're based, there's no volatility skew in these. They're based very linearly on the underlying. But particularly if you're looking at like binary options, you can actually see a wide variance in pricing. And the reason is we actually have more liquidity in the live market, more market makers, more liquidity providers in the live market, providing more competitive prices. Particularly from a bid offer perspective, than what we do in the demo. Also, as you would presume, they're doing us a favor, basically providing pricing. So I've actually seen people that were really successful in the demo struggle when they go to live, right? They're doing exactly the same. When you go into the live environment, you don't have to trade right away. What I do is suggest that you look at it. You'll actually typically get deeper markets, tighter bid offer spread, but there are some nuances in pricing. Also in the demo environment, we have thousands and thousands of people using it at any one point. And they don't always, I always say trade the demo, even though you're not going to learn to trade from it, trade it like you would a live account, right? If you're going to trade two contracts, trade two contracts. But in demo, you'll see people come in and trade 500 or 1,000, right? They're just treating it like a game. They're not serious about learning to trade or learning the mechanics. So you do see some price discrepancy. So I do just want to note that practice everything in your demo account. And just to avoid confusion, this is some contracts I had in. That I'm just going to close out quick. And I'll walk through the whole closing out process when we get into the boom. Actually, I'm already at my maximum loss on this particular contract. So I'm just going to hop over to the knockouts, right? And again, you can see the brackets. So real quick, if I wanted to be a buyer, this bracket has the closest floor. We'll walk through this. This one, the fourth bracket, it may be hard to see on your screen because they're light blue. Hopefully when I bring them up, right, they're just here along the side. So this one has the closest ceiling. Up here, I can find my price. So if I want to open up my order ticket, I'm just going to open up my order ticket. So now if I'm selling this contract, right, now I have a maximum risk of about $100, maximum profit potential of 400. I'm just going to place this order, right? So a couple of things I can do. Here, right? So let's do some hypotheticals, right? I just got into a trade. I know my maximum risk up front, right? I know that if I'm short, it's the ceiling, and I know that if I'm short, my maximum profit is the floor. Right? So if the market starts to drop, let's say I don't want to wait to trade this. I want to take profit. I want to lock it in at 31.70. What I'm going to do, I'm just going to click on this knockout contract. It'll open up an order ticket in the opposite direction. So if I sold, it'll open up a buy. So if I wanted to close out of this trade right now, I would simply click place order, right? So in this case, if the market was going against me and I wanted to place that order, right? So let's say the market where we sold started going up here and I had $100 risk, but I thought, you know what, it broke above this high level. I think it's going to go higher. The benefit to this is I don't take the maximum loss, right? I'm getting out with a smaller loss. And you do that and you accumulate that over time. $50 on a trade or two doesn't sound like a lot, but when you're looking at trading, hopefully you're not all just doing this to trade for a day or two, but you're actually looking to trade for a lifetime, right? When you start thinking about the pennies, even that can be saved over the lifetime of trading, not just 5 or 10 trades, but thousands of trades, and you start comparing the difference of a loss between $50 and $100, now you're not always going to do that, but in certain instances, if you're wrong and you discipline yourself to get out early, right, it can be very beneficial. For example, right now, if I said, okay, I'm down $5, the market doesn't look like it's doing, maybe some time has gone by, I could just close out by placing the order. When you're going to place a limit order or when you're going to close out, always use your open positions window. Don't go back over to this one, right? Because it's very easy to accidentally click the wrong contract. And then you don't have an order that's at all associated with the market you're trading. You might have a new position that gets established, right? So to establish a limit order, or close out, always use the open positions window. So I simply clicked on this line. It opens up the order ticket in the opposite direction. Now to set a take profit order, I'm going to change this to a limit order, right? To a good, and this is a good till canceled, right? So it'll stay there until the contract expires, or I either edit, amend, or cancel it, or it gets hit, right? So right now, I have one contract on. I'm going to go in here, and what did I say? I want to take profit if it hits 3170. So I'm just going to type in 3170, and I'm going to click place order, right? So now if the market goes down here, let me just bring up a drawing tool here. I'm just going to do a horizontal line. Now, one of the things we're working on is actually putting your order levels in these as well. But in lieu of that, I can just throw a line on there. I can just say, okay, that's where my limit order is at. In case I forget about it, it's good practice. It took me what? I was talking while I did it, but literally it takes me about 5 seconds tops. Because now if the market comes down here, right? Just like I don't have to wait for it to hit the maximum, if the market comes down, starts moving sideways here, I might just want to amend this order, or I may just want to close off altogether. So right now, if I want to see this working order, right, I can see that this is working right here. It's working at a price of 3170. Right? I like the visuals. I like putting that red line on there. Let's say that I just want to amend this order. Maybe I put it in the wrong place. Again, I'm going to go to my orders window, select the order that I want to amend. And so let's say I want to move it slightly higher, right? To 31, I'm just going to say I want to move it to 3175. Right? I'm just going to make it 3175, and I'm going to click amend order. So I've just amended my order. Now it's working at 3175. All right, let's hop back to our open positions window. Okay, here's another very important part, right? The market, let's say the market's moved against us. We're not down just $5, right? I see my profit, well, now it's $2. Let's say that was $25. I just want to close out this trade. I'm going to go ahead and click, again, for my open positions window. It's going to open the order in the opposite direction, and I'm just going to click place order, right? Now, my very next step, and whether you're doing this, like as soon as I close out that order, I want to go in and make sure I don't have any limit orders associated with it, right? Because if the market drops right now, I closed out my initial position, but if the market goes down to here, it's going to place a buy order, right? I've got a working order here. So I need to go into my working orders. Again, I'm going to click on this, and I'm simply going to click delete order. All right. All right, I'm going to get rid of this line here. Let's take a look at a buy order and using multiple contracts. All right, is everybody good with that? I had some lines on my chart from a presentation I was doing last night. Let me get rid of those. Whoop. Clicked off there. Okay, so we're looking to buy. So in this scenario, we're looking for a contract, typically where the floor is closest to the underlying market, right? So that would be this one. It's almost going to be always, right? The one farthest to the left for buy, the one farthest to the right for a sell. I say almost always because in some cases, if you're really close, if price is really close to a floor or ceiling, you might want to give the market a little more room to breathe, right? Maybe not, but in this case, you know, if it's really close, you may say, I don't want to just take the risk of getting knocked out and paying that buck and losing a couple bucks. I'm just going to give the market more room to breathe, right? I want to take on a bit more risk. So let's take a look at buying multiple contracts and some things that we can do as far as locking in profit early. I'm just going to go ahead and click buy, right? This is an order that I want to buy, so I'm going to open up my order ticket. All right, so I'm going to actually do 10 contracts on this one. So I can either use the up-down buttons or just type in 10. I'm going to click place order. So right now I've got 940 risk, to about 4,000 some potential profit. Place order. Now that'll be nice if both are hit in there. So I'm going to go back to my positions window, right? So we've got our trade on, right? Our maximum risk is that floor. You see that highlighted at 31.89. That's our maximum risk. What I want to do now is set up some limit orders. So let's say I do my analysis, and I'm just going to bring up a vertical line here, or a horizontal line, excuse me. And I'm looking over here, right? The market kind of hit this peak, and but maybe I don't want it to risk. Maybe I think it's going to slow down in this area. So right now I've got 10 contracts on, so I don't want to get greedy, right? One of the key things that I found in trading, and one of the reasons why I'm a big proponent of multiple contracts, is to be able to get it to profit, lock in some profit, and then let the trade run. Now, one of the things that I think that is going to be key to this contract moving forward, and something that I considered when I spec'd out, and we have a project in place, is to add stop orders to this contract. We don't currently have them. I mean, in one respect, it's nice because you have the floor and ceiling, which work as that stop. But if the market really moves in my favor, I might want to trail a stop behind that. So it's not available at this point, but something we're working on diligently. It turned into actually a much bigger project than I expected. But from the outset of the trade, you're going to use the floor or ceiling typically. So if you did want to close early, I'll walk through that as we wrap up this scenario. And I know we've only got, I think I've answered most of the questions as they've come across, but want to make sure to leave a little bit of time. All right. So this is the level right here. We'll say it's 32.15 that we're going to hit. So I've got 10 contracts on. Again, open positions window. Click on this. Open up an order in the opposite direction, right? Because I want to take profit, this is a limit order. Now I could close out all 10 contracts here, but maybe I don't want to do that. I'm just going to close out, I'm going to say 3 on this, right? And what did I say my price level was? 32.15, right? 32.15. I'm going to click place order, right? So now if the market moves up here, fills this order, I've collected profit on 3 of my 10 contracts, and I could collect it on 5, I could collect it on 7, right? Maybe I want another limit order if the market really continues to move. Maybe I want another profit because I think if it breaks up here, it's going to go up here, right? It's going to go up to 32.30. Again, I'm just going to click on this trade, right? I still have 10 on, so I'm going to do that. But maybe, I've got a limit working for 3. If it gets up here, I want to take 5 more off. Again, though, I want to change it to limit. I don't want to do it at market, right? Because if I do it at market, it's going to take it right where it is. So now I'm going to say, okay, so at 32.30, that's where I want to take another 5 off, right? And then I'll wait to see if the other ones hit there. But if both of these get hit, then you're great. You've locked in profit. You can't actually take loss on the trade. So right now we're up $70 in our trade. Maybe we're not up 70. Maybe we're down in this case, 200, right? And we just want to close the trade. Or maybe we are in profit and we just want to get rid of that trade. And by the way, this is recorded. So if you're not catching all of this, don't worry about it. I tend to throw a lot of information at you with the hopes, and I'm going to show you resources in just a moment where you can get a bit more into this. So, all right, so you know what? I've decided either this trade isn't working or it's not going to hit my limits. I just want to close it out for some reason, right? Maybe I want to lock in that $120 we're up right now, right? So I'm just going to go ahead and I'm going to click again on my open position, right? I want to close out everything. I want to close out all 10. I'm going to click place order. Boom. I'm out of that. Now, very next step, right? We don't want to leave those. We don't want to leave those working orders out there, right? So, boom. I'm just going to delete these. All right. I'm going to delete this order for 5. Now, one thing, and real quick on calculating profit and loss, right? So I'm setting these limit orders out. So if I look at this and I say, okay, I'm just going to use round numbers here. So 3,200 to 3,215. I know that's $150 per contract. If that gets hit, I had 3 contracts at that limit order, right? So that's $450, right? The profit and loss, by the way, will be a constant calculation that continues to run, right? You'll always know it going in on the trade what your maximums are. Let me just go back in and I'm going to delete this one. I'm going to place one more order to enter, right? So I'm just going to go in and I'm going to place another buy order here, right? So I'm just going to change this to a limit order, right? So my potential profit and loss, if I get in, my maximum loss is $109 based on where I buy to the floor. My maximum profit, if touched, is $391. I'm going to place the order, right? So I'm going to go here to my open positions window, right? Here's the order I just placed, the US 500 knockout. I'm going to see a floating profit and loss that is always calculated on these contracts in real time. As the market ticks, as the market moves, you're always going to know that profit and loss. And so you don't really have to do any complex math, right, on where your position is at. Now, if you're looking at it though, and you just say, okay, well, I got in here. If I go to here, what is my profit? Some just very simple math, right? You just look at it, it's $1 per tick. So on your market, if you say, okay, well, it's 150 ticks or 15 points higher. Now, some of this will just become second nature as you do this. So if you're not following this part, don't worry about it. You'll really figure it out pretty quickly as far as what profit and loss calculations are. So again, though, this is a very important part. I'm down $8. If I want to close it out, I simply click place order. So real quick before we wrap up, I think I've hit all the questions. If not, I do go back and I review the questions. I'll shoot you an email with any answers that I didn't get to. But one, I want to show you where you can find the recording of this webinar. It won't be up immediately. It takes about a day to get them up. So if you go to nadex.com, and I'll just walk you through this process real quick, nadex.com. All right. Underneath Learning Center, and we're actually working on really revamping this whole Learning Center. So there's going to be a lot of stuff, but there's already a lot of great information in webinars. So I want to show you how to use this tool, whether you're trading knockouts, whether you're trading binary options, whatever you're trading. Here's the upcoming webinars. Here's the one we're doing today, right? You want to register for any of these? By the way, if you register for them and you can't attend, don't worry. The recordings are available. We'll typically send the recording out to the registrants, a link to the recording. But even if you miss that email or you don't get it, you can always go to click here to the on-demand webinars, right? And there's actually right now, I'm just going to scroll to the bottom. I think there's 17 pages of on-demand webinars that you can filter by what you're trading. Is it binary options? We need to change this to knockouts, Forex, call spreads, whatever you're trading, right? So you go here. So probably by tomorrow, you'll see this, and you can just click watch now and watch them on demand. They're free, and there's a lot of great commentary as well as content here, right? If you want to look at a strategy that was done at our trading summit, our virtual summit a couple weeks ago, right? Here's a knockout option strategy, right? Lower risk, higher potential reward. That was done by Rockwell Trading. Click watch now, right? Take your time and learn these. Work in the demo account, right? That's an important thing. If there's a presenter you really like, Brian Caprice does an awesome job. In this one, he talks about average true range, analyzing entry exit levels. If you want to see all the things Brian's done, you simply click on the presenter, and all of his archived webinars will come up, and you can peruse through all of them, right? Take advantage of this resource. A lot of time has gone into it. We're going to continue to improve it, add more content. And I think I've hit all the questions, but again, if not, also let me just flip back to the PowerPoint, because we've got a great customer service team here, 24 hours around the clock through all market hours. They're here to help. So particularly if you have account questions like funding or, how do I withdraw funds? How do I put funds in? Whatever your account questions are, they're great ones and a great resource. They do an awesome job. If you question how a trade settled, another great resource. One other quick one before we go back. I'm going to go back here. If you have feedback on the contracts or the platform, maybe there's something you want to see, very important. Over here on the left-hand side, click the feedback button. Type in your feedback if it's on contracts. Now, don't use this for account questions, right? This is to give feedback on the platform, the contracts, things like that. This is taken very seriously. I'm on a team. We analyze these once a week. Things in additions to the platform are done by priority from what we're hearing. This is a true case of the squeaky wheel gets the grease. Simply click submit feedback. That'll go to a big report that gets collated. A team of us take a look at it. We work with our operations and development folks, prioritize what we can get done and what's the most necessary to get done on the platform. So I really want to thank you for joining me today. Take some time. Like I said, if you're new to these contracts, the demo will never teach you how to trade, but it will teach you the mechanics. It will help you avoid a lot of mistakes that people made. I know that I didn't listen to that advice in my much earlier days that were quite a while ago now. I did make quite a few mistakes, buying when I should have been selling and selling when I should have been buying. I believe for those of you that are probably closer to my age, that's an old Uriah Heep song, I believe called Stealin'. Stealing when I should have been buying. Anyway, with that, really want to thank you for joining us, joining me today. Really appreciate the participation and the questions. And again, look forward to the next one.